Welcome everybody to a Zoom webinar on monetary policy and income distribution. This is part of a series of webinar that I will be organizing with Guillaume Vallée and Silvio Capes, based on this book that we are editing, called Monetary Policy, The Future of Central Banking. And this book will be out in late 2020 or early 2021. And the book is comprised of 6 sections. And the first section is on the relationship between monetary policy and income distribution. Then there's a section on monetary policy and gender, the monetary policy on the environment, and so on. And this book is part of a series of 10 books that we're editing for Elgar on central banking and monetary policy. And the forthcoming books will have specific topic. We'll go over many of the topics in the first book, but in greater details with more people. So in this session, we have 3 chapters. In this book, we have 3 chapters on monetary policy and income distribution. But the actual book on monetary policy and income distribution will have about 12 or 14 chapters. And then there'll be a book on gender, a book on stability, a book on central banking and social responsibility, social banking and central banking and gender. So these books are part of a series. And we've decided to also have a webinar series to go hand in hand with these books. So this is the first one, and I'm very happy to have 3 speakers here today that are part of the first section of the book. And I'm going to introduce our 3 speakers today. The first speaker today is one of the co-editors of this book and of the series, Silvio Capes from the Federal University of Rio Grande do Sul in Brazil. The second speaker is Lilian Rolim from the University of Campinas in Brazil. And finally, Ivan Velasquez from the University of Kansas City, Missouri, but today who's coming to us from Maine. So the way I thought we could do it is I'll ask all speakers to have about 15 minutes to present what is, preliminary work. And I will invite some, since we're a small group, which is perfect, I'll invite some comments from participants. And we'll proceed that way after each presentation. I do want to say that this topic is very relevant to post-Keynesians. Chris Niggle wrote a paper in 1989 on the topic. Basil Moore wrote something on it, Philip Orestes, way back. And Mario Sequeira, who's here today, and Marc Lavoie have written also on the topic of income distribution, as have I in a series of papers with Mark Setterfield. So it's a very important topic. And I have to say that it's a topic that has gained a lot of attention in the mainstream. It's sort of now every central bank, Mario can tell you about it, but every central bank seems to be doing something about income distribution and monetary policy. And I think that post-Keynesians have to go back to the topic. It's an opportunity to engage with the mainstream because our conclusions are very different. But it's an opportunity to engage, and it's an opportunity to engage in a way to define the arguments, because right now if we let the mainstream take over this topic, they'll define the questions, they'll define the answers, and that's of course a big problem. And I think today's presentation by Silvio will address sort of the mainstream contribution to this topic. So on that note, I will invite Silvio to present. Again, my apologies concerning the lack of knowledge about this and not having you able to share your slides. Silvio, you'll have about 15 minutes. And I remind the others, if you can, to shut your, to mute yourselves while Silvio is speaking. Silvio?
Yes, can I start?
Yes, please.
Well, thank you for coming and joining us in the discussion. As Rochon already said, the focus of my chapter is more on the mainstream findings on the impact of monetary policy and income distribution. I don't focus on post-Keynesian work. This is not because I don't like post-Keynesians. No, I am friend of many Keynesians, and I myself consider to be a post-Keynesians. But the recent exposure, if I can say that, on literature on this topic, it is mainly from the mainstream, and it's econometric work focusing on personal income distribution and not on factor income distribution. And well, I will look to my slides. Unfortunately, you will not, but I will be looking to my slides to at least have a more structured talk. So the first thing to discuss here is the transmission channels from monetary policy to income distribution. And I will say here a definition of net financial income, which is important to discuss those impacts. And a definition of net financial income, it includes all sources of income of a household, be it poor or rich, such as labor income, interest receipts, business profits, government transfers, and capital gains, minus debt payments. And why is that? Because a change in interest rates, an increase, can make people that has bonds or deposits receive more income from those deposits or bonds, or less income. And people with debt, if they can renegotiate that debt, a change in interest rates can change also those expenditures. So this is also important to look. So a change in interest rate, monetary policy can affect income distribution in many ways because, for example, a reduction in interest rates can increase output, can reduce unemployment, and this reduction in unemployment, it reflects at the individual level with more people getting employed, and these people who get employment, it usually poor people. So this is one channel of distribution. It's the labor income channel. There is also the interest rate channel, which is, as I already said, the receipts of income from deposits and financial bonds. And those are the main transmission channels, together with the capital gains channel, because a reduction in interest rates increase capital gains in financial assets and vice versa. So there are two broad empirical strategies to assess those channels and see the overall impact of monetary policy on income distribution. The first empirical strategy is relying on aggregate measures, such as aggregate Gini coefficients and so on, or another measure of income inequality. And it usually uses vector autoregressions or local projections. So in the end, both generate impulse response functions. But this empirical strategy, it lacks the debt payment channel because Gini coefficients, they only take income sources. They don't have any measure of debt payments. And a second strategy, which is more comprehensive, but also requires lots of data, and because of that it's less used, is an empirical strategy that some people call a three-step approach, which is the first step is to run a VAR model or use any macroeconomic model to see the aggregate impacts of changes in interest rates. So a change in interest rates affect output, aggregate unemployment, and inflation. This is the first step, this estimation. The second step is to distribute at the individual level those aggregate changes at the household level. And for that, it is necessary to have household surveys. And many countries don't have household surveys or have with scanty data or not on a consistent manner. And the third step is to reaggregate the household level data and create income inequality measures. So those are the two main empirical strategies. One that uses only aggregate data, which is the most used empirical strategy because it requires less data, and with this you can look for more countries. And the second empirical strategy is that, which some authors call the three-step approach, which requires more data and therefore it's less used. So I will now go to the main findings of the econometric literature on the topic, and I will divide here my talk on the impacts of conventional monetary policy, and then I will talk about unconventional monetary policy because authors differentiate between those kind of policies. So now looking only to conventional monetary policy. Since I don't have slides, it will be a little bit, I will speak slowly because I have two pairs of evidence here and they are similar. It can be a little bit confusing. So one pair of evidence is that an expansionary monetary policy decreases income inequality, or the contrary, a contractionary monetary policy increases income inequality. This is what I call a pair of evidence because you have monetary policy going to one direction or the other. So just to recap, an expansionary monetary policy decreases income inequality, or a contractionary policy increases inequality. And I found 7 papers that point to this. Some of them study only expansionary monetary policies and say when you reduce interest rates, so an expansionary monetary policy, income inequality decreases because poor people get employed, and this turns the income distribution more equal. Or on the contrary, a contractionary monetary policy, an increasing interest rates, it make output grow less, it increases unemployment, and so poor people gets unemployed, their income decreases, and so a contractionary monetary policy increases inequality. This is one pair of evidence with 7 papers. There is another pair of evidence which is just the opposite. One that says that expansionary monetary policy increases income inequality. And this is because the authors of those papers say, because an expansionary monetary policy increases inflation and poor people cannot protect themselves from inflation. And therefore they are harmed by the expansionary monetary policy and income inequality grows. Or the opposite, a contractionary monetary policy decreases income inequality because a contractionary monetary policy reduces inflation and this is beneficial to poor people. And so there are 5 papers on this pair of evidence. So just to sum up, 7 papers point to one direction and 5 papers to another direction. And someone might look at this and say, well, the evidence is not so clear-cut because the numbers are similar. 7 papers point to one direction and 5 to another direction. But I myself favor the first 7 papers because among those papers, there are 3 panel data studies. And those panel data studies, one is Guerello with 17 countries, another paper with 32 countries, another paper with analyzes 10 countries. Some countries appear in more than one paper, but if we look overall, there are 43 countries on this evidence. And which evidence is that? Just to say it again, because you don't have the slides. It is that an expansionary monetary policy decreases income inequality, or the contrary, a contractionary monetary policy increases inequality. And there are 7 papers there, and among those 7 papers, there are 3 panel data studies with lots of countries included. On the 5 papers that point to the opposite effect on income distribution, of those 5 papers, 4 of them study only one country, 2 focus on Japan, 1 for Mexico, and another for United States, and only 1 panel data with only 6 countries. So because of this difference, not just because there are 7 papers that point towards one direction, towards one type of impact of monetary policy, those 7 papers also, they are, in my view, more robust because they analyze more countries. And the papers, that 5 papers that point to the opposite, they focus on single countries or a very small panel data. So overall, what I conclude from the econometric evidence on conventional monetary policy is that an expansionary monetary policy decreases income inequality, or a contractionary monetary policy increases the inequality. Now I will discuss the evidence on unconventional monetary policy, because those are different papers, they have a different focus and different strategies. And here I don't have these pairs of evidence, which makes the conversation a little bit confusing, because unconventional policy is always expansionary. So it can either decreases inequality or increase inequality. 3 papers find that unconventional monetary policy decrease inequality, and 4 that it increases inequality. And there is a nice division between them, because the 3 papers that say that unconventional monetary policy decreases inequality, they all analyze Europe. And the 4 papers that say the opposite, 3 of them analyze Japan and 1 for United States. So there is a nice regional division between the findings for unconventional monetary policy. And just to give an explanation of what causes unconventional monetary policy to increase or decrease, what authors say when they find that unconventional monetary policy decreases inequality is that it reduces unemployment. So poor people get employed or see a wage increase, and this makes them better. And for the papers that say that unconventional monetary policy increases inequality, they say that this happens because unconventional policy is based on the purchase of assets, and those assets are held by rich individuals, so they have capital gains, so the distribution of income becomes more unequal. So overall, what I think, summing up, I'm going to the end of my presentation just to point some things. The best evidence shows that expansionary monetary policy decreases inequality, and the main channel for this to happen is the employment channel. Unemployed people get employed, and poor people that was already employed, they see an increase in their wages, so the overall income distribution gets better. Or contrary-wise, the contractionary monetary policy increases inequality for the same reasons. Employed people get unemployed, and it's usually poor people that makes this change from employed to unemployed. And rich people with top wages, they are not so, how can I say, so sensible to changes in the overall or at the aggregate unemployment level. And just one final comment is a finding by a paper by Forsetti and other authors. They have a panel data for 32 countries, and they have a finding that I think it's the most important of all this literature, which is an asymmetry of the impacts of monetary policy on income distribution, which is increases in interest rates have a statistically significant effect on income distribution. But reductions in interest rates are not statistically different from 0. So when interest rate increases, it does have an impact on income distribution. But when the interest rate is reduced, there is no statistical impact on income distribution. And why is that important? This is important because many policymakers and mainstream researchers, they say that the impacts of monetary policy on income distribution, they are small and likely to net out over the business cycle. Because, well, interest rates go up and down all the time. So when it goes up, it has one effect on the distribution. But when it goes down, the impact is the opposite on the income distribution. And so it is balanced. In the long run, monetary policy doesn't affect the income distribution. This is what several policymakers say. But the evidence of this paper that analyzes 32 countries, advanced and developing countries, it points that it is asymmetric. Only increases in interest rate have a statistically significant impact on income distribution. Reductions of interest rates doesn't affect the income distribution. So monetary policy does have an impact on income distribution, even in the long run, because monetary policy, when interest rate increases, this effect is not counterbalanced when the interest rate decreases further away on the business cycle. So only one change affects the income distribution. And I think this is a good opportunity for research. I have a friend here in Brazil. We are trying to see how can we empirically assess this better, maybe include more countries on this study to really see, because if this is true, this is really important, and monetary policy has consistent impacts on income distribution, and they last over the long run, because only one direction of change impacts the income distribution. And when interest rates goes to the opposite side, it doesn't affect the income distribution. So this is a really important finding. So that's all that I have to say. This is what my chapter on the books cover, and I'm open to questions. Thank you for the attention. You have to unmute you. Louis Philippe.
Yeah,
Yeah,
still
now, okay. Now I hear you.
Silvio. I'm going to invite a few people to ask questions. I have a few, but I'll ask at the end. I wonder if Mario has a question or some comments. Maybe Joel as well. So, and anybody else, if you do, just unmute yourself and draw attention to yourself in some way. Mario.
Yeah, actually, no, I enjoyed what you're working on. That's very interesting. I have, I don't know, a general comment first, and then get to some particularities. The general comment is that I think you'll get less effect if you're looking at the personal distribution of income than you'll get if you're looking at factor shares type of analysis. And the reason is obvious, that if you're going to look like a Gini ratio, whatever, Gini coefficient, that is just looking at the personal distribution of income. I mean, you could have some effects even among workers, you know, you'll be the high wage worker, the low wage worker. You could also, of course, you'll pick up the effects of, you know, interest income earners, you know, that will enter into personal income, you know, in this case. But you got to understand that the amount that, you know, the interest income earners will get, you know, as a total share, it would be pretty small in comparison to employment income. So, I mean, you're not going to see the same effect there that you would pick up if you were focusing more directly on the, on, let's say, it's like rentier versus non-rentier income as an example, or whatever. So I'm just saying, statistically, you're going to have a more difficult time with it. Also, there are other questions that perhaps one would want to be concerned about. There's a whole broad literature that goes on. I mean, I remember looking at some of that stuff, literally in the 1970s even, you know, and I know it's a whole literature that goes back half a century for sure, if not more, which has to do with how income distribution, or specifically relative wages, okay? So it's not the Gini ratio one, but it will be if you're looking at other measures, you know, let's say you're looking at within the employment income earner side, okay? how the that personal distribution, or these inequalities, these income inequalities within these groups of employed persons, how they in fact evolve over the business cycle. And the reason why it's important is because there used to be, I mean, as I said, I don't know what it looks like right now. I haven't looked at it, honestly, so I won't even dare. Okay, try to predict. But I knew that there was a lot of controversy around that. That is to say, whether or not does a recession, for instance, is it more unequal, generates more inequalities in terms of wage earners here among themselves, okay, than does, let's say, a boom kind of thing. And and the reason why is because it's going to dominate those Gini ratios again that you're looking at. So you're going to have this thing happening, and it could give you some kind of, even I would say, almost perverse results. And what you need to have instead is rather a link between that and factor shares. If you could establish that link better, then perhaps it would be a more, I won't say more meaningful. I mean, what you're doing is meaningful too, but certainly would shed more light on what's actually going on here, because of the fact that these inequalities among groups, even among the employed person here, is affected in all kinds of ways here over the business cycle. So that if monetary policies has an impact, which is a big question again, to what extent does it impact on employment or unemployment? Okay. What are those elasticities in terms of the, as we know, I mean, there's a lot of debate around that as well. But if it does, and I do think it does it do it in this case in a way that will impact these relativities within these groups in all kinds of ways that is not so obvious, to predict, in terms of monetary policy. I'll just give you one example and I'll stop there because I know that I don't want to take over anything here. But I remember as a student, going back to the 1970s in this case, where I was looking at data. This is for Canada in this case, but I was looking at data here on the relative wages. Okay. What was interesting, I was finding, was that when let's say if indeed there's a growth in an economy, you have a growth in employment, which is what I think normally happens, okay, which is that as you start hiring at the bottom end, you don't hire people at the top end usually. Okay, there might be some of that, but much of the growth will be on the bottom end. Even though it's going to bring more people into paid employment in this case, what I was seeing there was that because you're hiring at the bottom end, the average wage within that sector was actually falling initially as you're seeing a recovery rather than rising. So when you're picking up, let's say in the case of these inequalities within groups here, you're going to see all these weird effects that you will not have if you're looking at factor shares, as an example, when you're looking at the aggregate of that group. Okay? And that's something that I think you'll have a hard time sort of disentangling if all you're looking at is these Gini ratios. Stop there.
Thank you, Mario. I think, Silvio, that's a good way of maybe at least dealing with it in a section of the paper, with the criticism of these of the various of the literature that you're surveying. Okay. Does anyone else have any comments or questions? Just on.
I do.
David. Is it David Ledbeater?
Yes, it is.
I recognize your voice. Can you turn your there you go. There you go. Hello, David.
Unmute myself.
No,
Can you hear me?
You're unmuted.
Okay, thank you, Silvio. I'm not surprised that there's contradictory econometric evidence, especially, following what Mario says, when it's not associated with, functional shares or factor shares. I mean, there's different ideological agendas going on, and different, you know, self-reinforcing selections of data going on, and so on. I think there's a shift going on in this debate, and I just want to sort of provoke maybe a wider examination and maybe a response. They're actually talking, even on the edges of mainstream media in the United States, about quantitative easing for the rich, right? Seeing a very clear class dimension to money supply discussions. And, you know, it seems to me that this is opening up a huge issue. And when you have, you know, people publicly advocating, even to the level of the US Congress, I don't think it's quite so sharp in Canada yet, but, you know, to the US Congress, you know, calling for quantitative easing for schools and the universities and states and so on. You know, we're talking about a very specific discussion of the institutional channel of quantitative easing and its impact economically. And I want to say that I think that potentially has will have a huge impact on some of the econometric studies. Okay, so I just want to say, if you've been listening to that debate and if it sort of offers anything. The second thing I wanted to say is that I really find the use of the Gini coefficient to be technically and economically passé. I mean, there's a whole history about Colorado Gini, which is very problematic, okay? And, you know, those who read Italian and who know some of the history, you know, can maybe say something about the history of economic thought. But even relatively mainstream theorists on inequality and poverty understand that the Gini coefficient is center-weighted, okay? And so I think it's important to think about other measures of inequality if we're still using the liberal framework of inequality. I mean, personally, I think a more important framework is impoverishment, you know, in kind of a classic Marxist sense, okay? But I actually think that you need other measures of inequality to go further on this. Now, it's even more critical that we actually talk about which interest rate, because there's a class dimension to the interest rates that different groups in society face. And I still have yet to see a really good study. There's notions of it. I mean, I remember even in my own PhD work on poverty in Canada and income distribution, that there was a lot of evidence about the kind of interest rate that the poor faced relative to upper income. So for me, it's an important question: how does the money supply and changes in the interest rate actually affect the array, the distribution of interest rates? So there is a pathway from an individual interest rate and protected an interest rate policy, but how does it actually play out in different macro contexts to the full array of interest rates? And I raise that with you, but there are huge differences in the credit card interest rates, in the payday loan interest rates on the one end, right up to negative or near zero interest rates for high finance, okay? And so there's a huge class dimension to the transmission through interest rates. I think I'll leave it there for a moment. This is a subject that could go on for a long time, but you know, it really has also to be associated, as Mario says, with the class or functional distribution of income. You know, not to mention wealth, and we really haven't even talked about wealth, because quantitative easing is most directly associated with assets. Okay, thank you.
Thank you, David. These are all very good comments. I think that Silvio's paper is narrower in scope, but I think, Silvio, there might be a way of introducing some of these criticisms, because if you're writing a paper and you want to focus on the mainstream, which is great, it's a great paper and contribution, but I think maybe at the end you could have a section on, criticism of the limitations of that literature. And I think you bring up a lot of what was discussed, brought up today. I think that would be a very good way. And then you can link it to various post-Keynesian stuff, and say, the mainstream, these are great papers, but these are the problems. And I especially liked David's comment about which interest rate. This is a very pertinent observation.
I didn't mean these as criticisms, I mean just these as questions,
Yeah.
because I think what you're doing is important to kind of do a review of the existing literature, but I'm just pushing to see where it can go.
Yeah, rightly so. Okay, does anyone else have a question? If not, we'll go to the second.
Could I just say, Louis-Philippe,
Mario? Yeah.
do you hear me there? I'm not sure if I'm muted or not.
No, you're fine.
I just want to say one little I think what David did say is important on the issue of the way in which the mainstream looks at income distribution. I mean, the reason why they prefer like Gini ratios or any of these that are they treat everybody like an individual, basically.
Mhm.
So you're not part of a specific income group.
Social class.
Or social class. And indeed, all that goes way back. I mean, you're talking about Marx. I mean, the reaction to Marx, in a sense, within the neoclassic or the early marginalists, like Pareto is a good example, is exactly that. They went away from that towards having these measures. So these income distribution based on individuals, as if everybody's an individual kind of thing, and we're randomly distributed our income in some way, and sometimes policy influences it in a certain way, sometimes in the other way. See what I mean? So if you just look at that, and the Gini ratio is exactly that. I mean, it just looks at, again, as we're all individuals, just receiving different types of personal income. And obviously, as I said, it will affect it in a certain way, the way you actually estimate or measure these impacts, So you will not normally find within the mainstream many people trying to analyze it in terms of the factor distribution or whatever you want to call it there, rather than the individual one, which is the Gini ratio. And yes, it's true that, I had a colleague, Louis-Philippe will actually know what I'm talking about here. I had a colleague in our who passed away in 2005. And no, it's not who you're thinking. No, it's Camilo Dagum. His name was. And he was an Argentinian, a very good econometrician, an excellent, econometrician, who, really, he had studied under Corrado Gini. He had, he had studied with him, and it's true. Corrado Gini had been tarnished badly, with all kinds of stuff, from the eugenics movement in the 1930s to his association with Mussolini and everything else. And he was somewhat, let's call it cleaned up after the war. But the point being that, yeah, there is a kind of sad history there. But, and I don't think these are independent of how they use measures and how they look at things, in a sense, right? And that's why I was saying I don't disagree with that, except that what are the established types of measures out there tend to be the ones that tend to look at people as if we're just a bunch of individuals who are going to get an income, and that's it, and that's what the Gini ratio does in a sense.
Thank you, Mario. You mentioned the reaction to Marx and the transition to the marginalist school. Philip Mirowski wrote a very good paper on that, on how how we move from a classical theory based on social classes to individualism, largely because of what you were talking about. I should try to find that paper again, and because I quoted it a few times, and I'll post it.
Would you
Okay.
post that?
Yeah, I'll post it when I do the video, and I'll post a link to the paper, or at least a reference to it. Okay, so thank you very much, everyone. Thank you, Silvio. Very good. We'll now go to Lillian, who is at the University of Campinas, and she will introduce her paper and talk.
Okay, thank you. Can you hear me well?
Yes.
Okay, great. So I'll also follow my slides, so I'm a bit more structured. Nice to meet everyone. My name is Lilian, and this chapter is co-authored with Nathalie Marins, and we're from the University of Campinas in Brazil as well. And the title of our chapter is Inflation Targeting Regime and Income Distribution in Emerging Market Economies. So although it's not an empirical work, we can talk a bit about it. Even after Silvio's presentation, there are certain things that are connected, so it's interesting to come after his presentation. So as an introduction, the motivation for our work was that, as we already discussed here, there's a post-Keynesian literature that highlights that monetary policy has an intrinsic distributive effect. And from that, there are some authors, some of which are also in this call, who have argued that the IT regime, the inflation targeting regime, can have some consequences in terms of income distribution. And along with other concerns that are related to the fact that it may be undesirable to have monetary policy focused on one objective only, that is price inflation, and that it may have adverse consequences for other macroeconomic variables such as output, employment, and income distribution. Post-Keynesian authors have proposed alternative monetary policy rules, which can be counter-cyclical rules, and also rules that are related to income distribution. And our aim with this chapter is exactly to establish a discussion and contribute to this debate by focusing on the specificities of emerging market economies and some lessons that we can draw from their experience with the IT regime. So I don't think we need to go through the IT regime in detail here, but what we would like to highlight is that it is a policy prescription that is based on the new consensus macroeconomics, and it is expected to control inflation through demand variables. So because inflation is seen as a demand phenomenon due to very high aggregate demand, changes in the interest rates are expected to act upon demand variables and then control inflation. One important exception to that is the exchange rate channel, which would have a direct effect on inflation through imported goods prices. So in this case, rather than being a demand variable, it would actually be a cost or a direct effect from the exchange rate to inflation. And this is particularly strong in emerging market economies, and it's known as the pass-through effect. And in the mainstream literature, it is perceived as the result of certain weaknesses of emerging market economies. However, there are other ways of analyzing why the exchange rate is so central to emerging market economies and why this channel is particularly relevant. And this alternative explanation would be focused on some structure or specific characteristics of emerging market economies. So one of them is that these economies' currencies are used in international markets in an asymmetric way, which leads their exchange rates to be more sensitive to external risk-aversion sentiment, and they are subject to very sharp depreciations. And also, there's a currency mismatch between assets and liabilities in these economies. Additionally, these economies tend to present an underdeveloped and less diversified industrial structure, which means that they have a higher share of imported products with low price elasticity, and also that their price indexes tend to be more sensitive to the exchange rate. So, how can we make sense of this phenomenon that is observed in emerging market economies from a post-Keynesian framework? Well, in order to do so, in the chapter, we rely on the post-Keynesian inflation rate theory, which, to put it very simply, it is based on the definition of prices. So prices, as there's a paper, I think, by Rochon with Satterfield, which puts it that prices are basically made of costs and profit margins, right? And if we think about a closed economy, costs are wages. So inflation arises whenever these costs or profit margins grow, and they can grow if there are demands for higher nominal wages, or if firms are trying to protect their income or increase their profit shares by increasing prices. So in this case, either if there is an increase in nominal wages or if there's an increase in firms' desired markup, there would be an increase in the inflation rate. And because in this framework, we always have a relationship between inflation and the wage share, we would also have an effect on income distribution. Here, we are always talking about functional income distribution. So in this case, the wage share. So in sum, we can say that in this framework, as Satterfield puts it, inflation is basically determined by conflict and power. And how can we assess the impact of monetary policy in this framework? Well, as Smithen has claimed, if there is if the interest rate affects any of the variables that determine how this class conflict takes place, we can reintroduce a channel through which changes in the interest rate affect certain variables, which then affect the inflation rate. And in this case, there will tend to be an effect in terms of income distribution as well. So what we do next in the chapter is exactly to explore not all of the possible channels to which interest rates affect income distribution, but some of them which are most relevant for our analysis. So the first channel would be a direct effect of the interest rate on income distribution, which has been emphasized by Fazinetti, Mike Lavoie, and Mario Saccareccia, which is based on the idea that the interest rate is itself a distributive variable because it redistributes income from debtors to creditors. So if we assume, for instance, that workers are indebted, if there is a decrease in the interest rate, it means that financial profits that resulted from workers paying their debt and their interest payments will decrease, and then there will tend to be an increase in the wage share. So this would be the first mechanism. The second mechanism would operate through economic activity. And in this literature and many contributions, it's assumed that increases in economic activity will tend to benefit workers, and they will have a higher bargaining power, which can lead them to actually gaining some increases in terms of nominal wages. And then their wage share would increase, but we would also observe some increase in the inflation rate as firms try to protect them from themselves by increasing prices to some extent at least. So in this case, we would have, if a lower interest rate leads to higher economic activity, there could be an increase in the wage share. But this first link between interest rates and economic activity is open to debate as well, because there are some authors that argue that interest rates are unlikely to have an impact on investment, but then it may be possible that interest rates affect residential investment and consumption of durable goods. But if there is such a mechanism, we would observe a higher wage share through this channel. The third channel that we emphasize in the paper is the direct impact of changes in the interest rates on firms and their desired markup. And this has been discussed in the literature through different angles, let's say. But we think that the simplest way to explain it is that if firms perceive their financial costs as a production costs, they will be reflected in their markup, and especially the markup that they apply over wage costs. So if there is a decrease in the interest rate, firms will perceive that some of their costs have lowered, and thus their price may be reduced, which would have a positive impact on the wage share and also decrease the interest rate. So in this case, we would observe a positive correlation between the interest rate and the inflation rate. And this has been identified also in the mainstream literature and is known as the price puzzle in this literature. Finally, we have the fourth channel, which is the exchange rates channel. And well, through the pass-through effect, which we explained in the part related to the IT regime framework, through the pass-through effect, if a decrease in the interest rate leads to a currency depreciation, we would observe an increase in the interest rate, in the inflation rate, because imported goods prices would go up. There is a second effect which is emphasized by post-Keynesian authors, that is the effect of a depreciation in the domestic currency on firms' markup. And the explanation for this is that, well, first, if there is a depreciation in domestic currency, domestic firms may perceive their international competitiveness as may perceive an increase in their international competitiveness, and then they can desire a higher markup and increase their price levels. Also, firms that sell tradable goods have their prices defined at the international market, which means that once there is a depreciation, they would tend to, their price in domestic currency will increase. So from this channel, we would have a lower interest rate leading to an exchange rate depreciation, and then an increase in firms' markups, which would have a detrimental effect on the wage share, but also increase the inflation rate. So to sum up, from all of these channels, what we can see is that monetary policy is likely to have very different partial effects and may possibly contradictory partial effects on income distribution as well. So how can we assess the IT regime impact on income distribution from this framework that we developed in the chapter? Well, given that it's quite complex, we suggest that the best way to analyze it is to separate the impact on 3 layers, and these 3 layers will interact with each other. So at the first layer, we would have the strength of the different transmission mechanisms. So as an example, if we have that economic activity is the main transmission mechanism, we would expect that increases in the interest rate lead to a reduction in economic activity and thus harm workers' bargaining power and lead to a decrease in the wage share. The strength of this mechanism is likely to depend on labor market institutions, for instance. On the other hand, if we have that the exchange rate channel is the most relevant, the effect of the IT regime would be to control inflation through an appreciated domestic currency, which would tend to favor workers as they would have a higher wage share. But the strength of this mechanism and whether it is present or not depends on the interest rate actually affecting the exchange rate, and this can depend on the global risk aversion. So if it is low, it's more likely that increases in domestic interest rate lead to a currency appreciation, and then this mechanism would be more relevant. And of course, it interacts with the other mechanisms that are in place. At a second layer, we would have the inflationary sources that trigger monetary policy responses. So if, for instance, the inflation rate is caused by an exchange rate depreciation, which by itself has a negative effect on workers' income share, and then the IT regime increases the interest rate, we would observe an even lower wage share as workers would be negatively affected by the effect on economic activity. So in this case, the IT regime would reinforce the result of the exchange rate depreciation. On the other hand, if we have inflation caused by an increase in workers' bargaining power, if the
this is playing right now.
Can I just give you your hand? Let me show you, because
and this leads to an exchange rate appreciation. Not necessarily we will observe a reversion of the gains that workers have had when they had a high bargaining power, because the domestic currency appreciation will tend to favor their income share. And finally, we have the IT regime institutional setting. So if the inflation target level is very low, and if the tolerance band is very small, it's likely that the regime leads to a very high interest rate. But what will be the effect of this high interest rate? Well, from the discussion of the chapter, what we argue is that it will depend on how, which are the transmission mechanisms in place, how strong they are, but also which are the inflationary sources. So as a key takeaway from this discussion, we argue that the ITE regime's distributive effect will depend on structural, institutional, and conjunctural factors. And because of that, one should not expect a unique effect of the ITE regime across different economies, both in terms of the sign of this effect and how relevant it is. And that is particularly in emerging market economies, where we have a very strong exchange rates channel. So just to conclude, well, emerging market economies' experience with the ITE regime adds further elements to a critical assessment of this regime. We have shown in the chapter that monetary policy may have different partial and possibly contradictory effects on the wage share. And this means that its effect would be strongly dependent on country-specific characteristics, which can also change through time. So maybe that's where our work relates with Silvio, that sometimes you cannot find one effect. And as a lesson for rethinking monetary policy, especially when it comes to emerging market economies, we argue that it may be insufficient to focus only on alternative monetary policy rules if we don't take into consideration what can happen to the exchange rate at the same time. Because what happens with the exchange rate may prevent monetary policy from reaching its objectives. So what we argue is that monetary and exchange rate policies must be framed in a coherent way, and that may also require additional instruments to control the exchange rate. I think that's it from our chapter. Thank you.
Thank you very much. I'm not going to comment directly on it because I know, Mario and I are currently writing a paper on this very similar topic. So I'm going to let him speak about inflation targeting regimes. But I did, one thing that I liked is a discussion of various channels, and what would be very nice in your paper from a pedagogical perspective is if you have some sort of diagram that has, interest rate, and then you have the 4 channels, and then you can talk about these various channels. I did that in what I sent Mario actually last night. I only have the wealth channel and the income channel, but I think it does help in sort of putting our thoughts together visually. It's I think it's good. I'm going to turn to Mario because I know he's got a lot to say about inflation targeting regimes. And well, anyways, I'm not going to say more. I'm going to let him say that. Mario? Oh, let me unmute you.
But
There you go.
what could I? Actually, I'm not sure what's going on here. I seems to have unmuted.
No, you're fine. No, now you muted. There you go. Now you're fine.
Okay. I'm seeing all kinds of other stuff here appearing. I don't know what's going on. Okay. Well, first of all, I appreciate what you're doing, Lillian. I mean, it's great. And I'm very happy. And actually, all the stuff on the exchange rate, I'm really interested in because of the fact that we have, like I never really understood why Brazil, for instance, or many of the Latin American, Mexico even, you have such huge pass-through effects, even if they've gone down over time, apparently. While here in Canada, we've had a floating exchange rate for God knows how long now. And, and the pass-through effect is so much lower. And my only conclusion was that it has to do with the degree of monopoly, within the sectors that are going to be affected by it in some way, in the kind of Kalecki sense, which would indicate to me how these pricing models that you have implicitly talked about should actually try to capture this in some way, because there are, Just to give you an example, and then I'll jump onto the inflation targeting as such there. But on the issue of pricing, I think it's critical here. If you take, for instance, let's take the Kalecki basic simple model there, where you have essentially prices as some markup on unit prime costs here. Now, what goes in the unit prime costs? We usually have labor costs or some other things, material costs, or I don't know, whatever there you have. And if you're importing those material costs, then it's going to go through directly, for a given markup. But on the other hand, if you have, I'll give you an example, you have interest rates going up, they're going to enter into what he called overhead costs, basically, because they have a certain level of debt. And therefore, they will be trying to cover that, but they won't cover it right away in the kind of basic Kalecki model. Rather, it's going to evolve over time, meaning that as overhead costs rise, if you have an economy where interest rates are rising or they're very high, it's going to filter into those markups over time, but it will not necessarily be, right away. It's going to, it won't trigger that effect, in this basic model. But if you have instead a full cost model, for instance, you're going to have a completely different effect there right away. Okay, so the way in which you actually model this, I think, is important to be able to, just on the pricing side here, is important to see to what extent this impacts through the exchange rate and everything else. So that's my comment on that. As to the issue of inflation targeting, well, I mean, to me, it's so obvious. I've been arguing this for a long, long time, really, which is that inflation targeting is essentially an incomes policy, okay? And by that, I mean that it is directly going to it's going to have an impact on the way in the labor market specifically, and not just, we know directly it impacts on those who are the income earners, of interest income earners rather, but it also is critically important in the way it's perceived within the labor market. And the way inflation targeting works, the way I've argued, and I must say that I've written some that stuff. I remember we did a paper with Mark in 2010 for a Festgriff in honor of Phil Restis. And there, I even discussed the fact that if you go to the first country that introduced inflation targeting, they did it for exactly that reason. They wanted to apply some sort of wage control in the public sector. This is, in this case, New Zealand in the late 80s. And instead of going that route, they decided that it might be less problematic for rather obvious reasons, because you're going to, if you apply wage controls, you're going to have a fight with the unions, you're going to end up in the courts and everything else. And one way to avoid that was to simply come out with this inflation targeting, which would then force them to sort of, employers in this case, including the government, to say, well, we must abide by that 2% rule or whatever it is. So it becomes a norm that is going to be either directly impacting on decisions within the labor market, primarily through the employer, but also employees who think, well, if we really believe in the credibility of the central bank in pursuing that policy, if you ask it, like, for instance, right now today in Canada, if you were to ask most trade unions and ask them, what do you think the inflation rate is going to be next year? Obviously before the coronavirus, it would have been actually more obvious than now. But even with it, I'm willing to bet here that most of them will still say around 2% because it's so deeply ingrained. So there's that part, but there's also an employer that's going to be able to use that to enforce that, which means that wages are going to start to smooth out at 2%. Now, if wages and prices are going to smooth out at 2%, okay, what's going to happen? Well, what's going to happen that all the increases in productivity will not go to labor in this case, and therefore you have this kind of declining share of labor income, which is what we are seeing in Canada throughout the inflation targeting period. And it's not specific to Canada. So my point here being that it's obvious if we have this kind of nirvana here where we have 2% price increases like we've had, well, not recently, as I said, because of the coronavirus, COVID crisis right now, but until let's say February, what we were having was essentially wages and prices moving around that steady path of 2%. So that in itself is an income distribution bias. It's embedded in the way it's formulated. And this is something which, if you go back to the way they pursued income policies in the 1960s and 70s, when they had different types of income policies, either the voluntary types, the guidepost types, like in the US, or even in Canada, we had here with the Prices and Incomes Commission, or even in Britain, the way in which, or later on, even the ones that were compulsory, even in Canada in the 1970s, we had these compulsory types of income policies. All of them were concerned about the income distributional effect. All of them, even where they enforced a certain policy, they would say, look, we're allowing wages to rise, maximum allowable will be, let's say, 6%, okay? In order to at least get some of the shares of productivity growth, so that even if prices are rising, let's say, I don't know, whatever, at 4%, you're going to get some of that in terms of share, so to maintain the share of the pie here constant, to have a neutral, quote unquote, effect on the income distribution, in this case, between labor and non-labor income. This is how they pursued it. And what we see here is a complete sabotage of that via inflation targeting, which is a form of income policies as well, but it's completely biased in its effect, okay? And that's the outcome of that. So that's something that, which of course structurally also leads to how markups are gonna rise. So if you're gonna see during the same period, you're gonna see markups rising, it's because of that, you could argue. If that was an important element in the way in which pricing and wage changes impact on the economy, then you're going to see that a regime, a monetary policy regime like that one, is going to also bias the way in which markups are going to evolve over time.
Thank you, Mario. I'd like to point out that you published a paper on inflation targeting regimes in the Journal of Economic Issues, 2018, was it? Early 2019? Do you know the
yeah, it was last year. The one on the on Galbraith stuff there and all that. Is that the one you're thinking? Yeah.
Yeah, I think so.
I've done there's a few of them. I actually have looked, but yeah, there's this one in the JEI that came out in June of 2019. Yeah, that's right.
Okay. Very serious. Okay, so
yeah.
I'll put a link.
Yeah, I was just highlighting then, just with some graphs there about the wage shares again, and you see that for a lot of countries. I mean, now also I should mention that even though you don't have an inflation targeting regime, it doesn't mean that you're not doing it. I mean, the good example is the US. I mean, everybody, in fact, some of the well-known mainstream kind of writers like Svensson, people like that, all of them were saying that the Fed was doing implicit inflation targeting for a long time. Okay? They just never called it that. And part of the reason is because they had to, politically not be acceptable at the time, until they finally, this is Bernanke finally came out with that. Okay, so that even in any kind of regime where inflation becomes the concern of a central bank over and above anything else, you're going to end up having these kind of effects, period.
Yeah. Okay, does anyone else have a question? If so, you can unmute yourself. Joël?
Yeah, Juliette, I just wanted to I wanted to say, first of all, it's reinforced some of the things, the same ideas came to mind a little bit that Mario was saying or whatever when I was reflecting on your work, Lillian. So first of all, I wanted to mention how I really appreciated the idea of looking at it in a layered perspective like that, how I think it's very useful to look at it in those layers, how you have the first layer having the most significant impact, and then the second layer reinforcing the impact of the first one, and then the third, the institutional setting. I thought that was really wonderful, and it's something that we can do, pretty, easily, I think, you know, as a post-Keynesianist, incorporating those institutional factors. But I would go even further and ask the question, maybe at the end of the paper or for future reflection, to say, like, how can we strengthen the working class to be more resilient in the face of this kind of inflation targeting or fluctuations in exchange rate or changes in the interest rate? How can we strengthen them so that they can be more resilient, so that the wage share stays strong and maintains itself through these different fluctuations that are kind of coming from monetary factors? So that would bring us exactly to the same kind of, you know, things that Mario was bringing up, which was, you know, what are the institutional structures that are in place in these different countries that we're dealing with? So whenever we deal with a new country, we want to look at the institutional structure through which, you know, those different effects affect the working class. So you say, okay, well, you know, we have this institutional structure where, you know, we have the working class operating at the bottom of the income scale. We have 20% of, you know, people having, you know, 10% of the, or 50% of the total wealth. How is an increase in the interest rate going to affect both groups? And then you can have the total impact. You say, like, you know, you can have the structure, it passes through, you have the outcome. So you can actually have like a real output from input. Do you know what I mean? And you're dealing with each economy individually, and that's the distribution effect. You know, every time you increase the interest rate, you're going to fuck the working class by decreasing their interest rate by, or their wages by 20%, or increasing the wage of the top class by, or not wage, but earnings or profits of the top class by such and such a percent. So I like that layered effect, but I think the way you can make it real, you know, is maybe going in this kind of way, how to model it or whatever. But yeah, I just think that's a really good way of thinking about it. So I wanted to put that out there.
Thank you. One recommendation, Lillian, is don't use the word fuck in your paper.
Sure. Thank you for the comments.
I think that what Joelle is getting at, she's a big proponent of making the working class great again. I think this is what she's
Fair enough.
Okay, thank you very much.
Thank you.
Any other questions? If so, please unmute yourself and speak. No. Okay, well, thank you, everyone. This was a good paper, good discussion again. We'll now go to, did you pronounce yourself Ivan or Ivan?
Either is okay.
Okay.
Ivan in Spanish.
Ivan, on his paper, he'll present his paper and the contents of it.
Okay, so hello everybody. I want to thank Dr. Rochon for inviting me to this book and to this presentation. So my chapter in this book is about monetary policy in the United States from a modern monetary theory perspective, right? So it's going to be a more kind of theoretical approach, how we can think about the change in monetary policy from United States from 1970s to 2015. The key point here is analyzing the effects on the functional income distribution, because I think for macroeconomics, this is the important distribution of income that we should look at, right? So this goes also to Andrew Glynn, who he used in 2009. He wrote something about going back to study the functional income distribution as an important factor for macroeconomics to understand how our policies affect the different classes, right? My paper then is a modern monetary theory paper, but also it focuses on the reference regulation theory, in the sense that I use the different regimes of regulation to see how the monetary policies have changed in the United States. And all of this is linked through the Minskian analysis. So what Minsky used to say is that in the neoclassical approach, all the disturbance that you have in the economy are caused because of the usual billions that are monetary system and the government. So that is in the sense that everything that is going wrong in the economy is because the government have done something bad through policies. And also, before 2008, there is few articles that you can find where the Federal Reserve or any paper related to monetary policy talks about income distribution. So here, that is explained because we know that in the neoclassical approach or the new monetary consensus, the topic of functional income distribution is not that important, and it is explained through the factor pricing and so on and so on. However, I consider, and following Piketty, that there are some political shocks that help to understand income inequality, and that can be explained through an analysis of the monetary policy through the MMT lenses. Okay, so first of all, we have to define monetary policy from the MMT approach. We know from like the conventional analysis and the whatever you teach in the for textbooks, usually monetary policy and fiscal policy are split in this analysis. However, we know, and that is something that MMT has brought through the discussion, and right now is the relationship between monetary policy and fiscal policy. We cannot think about these two policies apart. So they are complementary and they coordinate their actions. However, in the neoclassical approach, all the discussions are always focused on the idea that the central bank, the institution that focus on monetary policy, is independent and should be independent of the government. So this goes to Alesina or these authors who talk about the independence of the central bank as an important achievement of our economic system. But this started just in the 70s. Before the 70s, you can see that there was pretty clear a coordination between fiscal policy and monetary policies. And this is, Kant has an article on this coordination, and it was pretty clear that the both authorities, the both type of policies should be coordinated. Then from the MMT approach, we define monetary policy in a different way from and fiscal policy in a different way, not as a different institutions, but it depends on the effect that it causes. So we can define monetary policy as any policy that affect the interest rate, right? So the central bank sets an interest rate, and with coordination with the fiscal authority, they achieve and met the interest rate they are targeting. And fiscal policy is going to be any policy that affect the financial wealth of the non-government sector, right? And besides these two, I want to bring the Minskian component, that is the macroprudential regulation, as a part of the monetary policy. So Minsky was aware that in the United States, we cannot think about monetary policy just as something that controls the interest rate, but also any policy and any regulation that regulates the financial system. So from my content is that we have to think about monetary policy as those policies that affect the interest rate and those policies that are related with the regulation or the macroprudential regulation. That is something that is, after the 2008, started to be talked again in the neoclassical approach. So this Minskian component is very important. Why? Because when we look at the different regimes of accumulation, from the Fordist mode until the financial-led mode of regulation, regime of regulation, we can see that the change in the macroprudential part in the regulation of the financial system had played an important role on affecting the income distribution. So We know that at the end of the 70s, when it's the end of the Fordist regime of regulation, there was a change in the way that the monetary policy was conducted in the United States. They started to focus more on unemployment and on inflation, actually. And they start to use these monetary policies to in response to the fine-tuning policies from the orthodox Keynesian approach. There is a quote from Alfred Hayes, who was the president of the Federal Reserve Bank in New York, that says, a rise on unemployment is a necessary condition for shaking the inflation spiral. The slowdown is what we have been trying desperately to achieve. So they were trying to control inflation through what Lilian was saying before, this idea of through unemployment, right? So this is pretty clear since the end of the beginning of the 70s. Then we have the second part of the change in the monetary policy, as I define it, that is the period of the Reaganomics. So at the end of the 70s and the beginning of the 80s, with Volcker as the chairman of the Federal Reserve, we see the use of the monetary approach, and also the regulation of all the financial system through what Reagan was trying to do. And it is seen by the members of the board that that was very important. Why? Because was through the regulation of the financial system plus the clear content against the labor force, the workers, when Reagan stand out against the strike from the air control, traffic controls in the states, that the Federal Reserve have the power to use this unemployment buffer, right? So they could control or create price stability through the use of unemployment. This is when you have a rise on unemployment and a start of a slow growth in the economy through this monetary experiment. And then we have the last regime, that is the finance-led regime, what is that we call also financialization. This regime is started, although we can divide the different regimes in times, we can say that the roots of the regime started in the end of the 60s, and it goes until the 2000s, when all the different financial institutions, thanks to the regulation they got, try to, and the all regulation they got, they start to create different measures to bypass the regulations, the regulation Q. So this is where Minsky becomes important, because Minsky tells us that we have to change our regulations through time, right? So, and this is part of how this is going to be affect, the monetary policy is going to affect our income distribution. So the financialization helps to these financial institutions to bypass the few regulations they still had. And in the 90s, they create, in the 70s, they create the euro dollars to bypass the regulation Q. In the 90s, they start to create the creation of the credit default swaps. And that is also affected by through the different kind of guides that are created by the Bank of International Settlements that doesn't take into account the institutional factor of the country. So that helped to create this financial-led regime. How is that important? Well, this is important because Minsky argued, and I agree with him, that there is an important channel in our monetary policy that is the market channel, the capital market channel, sorry. It's through that mechanism that the monetary policies decisions taken by the Federal Reserve affect the whole structure of our economy. So it's through the capital channel that has been shaped by the regulation of the central bank and all the other monetary policies that the Fed took before, that we have an effect on the functional distribution. How? Well, the structure of the capital market in the financialization regime we have created that the short-term investment is the important investment. So when the Federal Reserve, for example, the Federal Reserve reduces the interest rate, what they create is an incentive to an increase on short-term capital investment. This is related with the shaping of the capital market in the sense that from the 80s, we know that there is what Dr. William Black calls capital, the fraud of the financial system. And it's in the sense that all the CAOs and all these manager decisions are affected by the gains they can get on short terms. So this shaping of the capital market channel helps to incentive, to create an incentive on short-term investments, and that goes against the wage share in the sense that they create an investment on short-term but not long-term investments. So with all the reductions of interest rate, for example, that will affect our functional income distribution for the wage share in a bad way, in the sense that we are reducing the wage share. And the other way around, when they increases the interest rate, the nominal interest rate, that creates an incentive to invest in long-term relationship, in long-term investment, and that possible will affect in a positive way our wage share. So we have to look at the following Minsky. We have to look at the capital channel, and that is something that started to be done from few neoclassical papers. One of them is in Chamy in 2000s, where he started talking about how the equity market affect the distribution of income and is a channel to control inflations. So that is in short what I present in this paper that is a theoretical paper.
Thank you very much, Ivan. Does anyone have a comment or a question regarding the paper? If so, please unmute yourself. I'm going to kick off the question. I was not exactly sure, and maybe because I probably don't know all the details about MMT, but what were you saying about the relationship between fiscal, like how does that enter your paper, the relationship between fiscal and monetary policy that you were talking about at the beginning?
Oh, I look at that on the different regimes of regulation. So we know that in the first regime of regulation, you got an important fiscal decision in the government. So in the first regime of regulation, fiscal policy plays an important role. Then when you have in the 70s, the separation, the total split between fiscal policy and monetary policy, and where fiscal policy is not seen as an important policy to affect or the different macro variables in our economy, we just get monetary policy without any coordination. So you got an experiment with the monetary experiment that this lack of coordination creates a really big problem in the Volcker area. And although they don't point out that the neoclassical approach doesn't point out that they have to go back to a kind of coordination with the fiscal entity, with the treasury, to achieve or to meet their goals, their targets. So my point is that when they tried, or when they present this split between fiscal policy and the fiscal entity and the monetary policy entity, they create a problem. And also I try to highlight this because this is an example for the rest of our countries, unless in Colombia, we got this split between monetary policy and fiscal policy. And that, in my opinion, has created a lot of problems for the income distribution over there. There is not role for fiscal policy, and they try to control everything to monetary policy, and not even macroprudential, but just through the change in interest rates. And that's how I link the need to have coordination between the fiscal policy and the monetary policy to understand monetary policy as a whole.
Thank you very much. Anyone else?
Could I just say one little thing here? I mean,
Yes, Mario?
Yeah, I completely agree with you, Ivan, that the whatever you want to call it, a regulatory structure of the, in place is so important. I mean, we've seen how since the 70s or 80s, whatever, we saw how, for instance, deregulation in all sectors, including in the financial sector, by the way, obviously, can impact in all kinds of dramatic ways. There's a whole bit on, I mean, all this stuff on financialization, like Lazonic and all these people point to that, as so critical. But the issue, how does that connect with monetary policy? Now, obviously, when we refer narrowly to monetary policy, we're thinking exactly, primarily interest rate policy and how it will play a role. As to the coordination issue, I mean, it's true that institutionally there could be a big difference. I'll give you a simple example. Here in Canada, we're probably one of the closest to the MMT world almost, the way in which our central bank exists institutionally vis-a-vis the fiscal authority. We are not an independent central bank. We don't have, an independent central bank compared, let's say, even to the Fed in the US. Absolutely not. Okay? This was created by the state. It's a public institution, and it plays, and it is dependent essentially on the fiscal authorities' decisions and law. They have independence in how they pursue policy, quote unquote, but there's always an overriding factor, which is what the Minister of Finance has to say here. And that's something that has not changed over since 1961 exactly, when they had a fight over it at the time. Okay. And so in that regard, but if you compare that institutionally, let's say to the Eurozone, where have the most sort of, what do you want to call, the most independent, quote unquote, of central banks, but certainly plays the role that it wants to play whenever it wants to. Okay, and as I saw with the Greek crisis in 2015, what it was doing, okay, that it could also manipulate, it could do all kinds of things that pertain to what are the interests within the Eurozone, which in this case happened to be the Germans primarily at the time, as an example, in the way they will try to, influence decision making. And that is obvious. So you have all kinds of differences there. And the MMT issue here has to do with whether or not the central bank can directly play a role on the fiscal side here in terms of the financing of spending. And obviously in the case of the Eurozone, it's illegal, except that we're seeing it happening the back door, especially over the last while here. Since 2015, essentially, through QE, indirectly conditioning the financial markets. But at the same time, it's still illegal, quote unquote, to going back to the Maastricht Treaty. So you got these differences. They're very obvious, but I'm not clear as I said, when it comes down to the crunch here, what we see, and a good example of the US Fed, is that when it comes to the crunch, the so-called independence is really not an independence, so that it could always play that role, and it acts that way. Okay, in this case, it's just a game in how they play it out in terms of the financing of spending of the state as the first run. I mean, I've always supported the idea that the central bank is always there. In times of crisis, especially, you could see this, it's always there to purchase government securities. And then it's going to just play out its role in trying to, free itself of that in order to be able to say that we are not, we're not going to follow, we're not going to support or whatever it might be directly the financing of the state here. So-called monetization of deficits and all this sort of stuff. But it's just a game. It's never really, the reality of it is that even if you are a so-called independent central bank, it could still do that. And indeed, they often do that, And in our case, it's not even a question. This is the way they will do it as a first run, So you get all the, as I said, I see all that, but I'm not quite sure why is it so critical other than as a purely political discourse and not doing certain things, not as if it's a real constraint one way or the other. Okay? The most constraining one, as I said, is the Eurozone one. Okay? And even that one, I think they could fool around with it, Anyways, I'm just thinking about it. I don't have a simple, but I'm not sure why you make such a big thing of that.
Thank you, Mario. Ivan, do you want to respond?
No, I agree with you. I bring this is just in the way to define monetary policy from the M&T approach. It's like fiscal policy, monetary policy are defined in a different way from the conventional approach. So that's why I brought this definition of them. Fiscal policy are those who affect the financial wealth of the non-government sector, and monetary policy, whatever policy affects the interest rate. I pretty agree with that. Now, the thing I add is the Minskian idea that monetary policy is also the regulation of the financial sector. For him, he says in one of the papers that, monetary policy in the United States is pretty hard to understand because it's not just one entity, but a different, it's an amount of entities that are in charge of monetary policy, talking about regulation of the financial system. But no, I agree with you with your comments.
Thank you very much. Joëlle?
Hi, so maybe I just want a little bit of clarification. And I enjoyed your paper, but I had some questions about, what we can think of, like what can stimulate in terms of our thoughts for the future. So, you brought into in the front of us the idea that Minsky monetary policy in the US anyway affects the economy mainly through the capital market effect. And so you're saying that it decreases it, and that all the innovations that occur in the financial markets as a result of decreases in the interest rate occur in order to free up money. So when the interest rate is decreased, and that's monetary policy in the US, that's supposed to be expansionary monetary policy, is decreasing the interest rate. When we decrease the interest rate, what Minsky is saying is that we're making it possible through these capital market channels, and that's the biggest effect that monetary policy has, to free up a bunch of money for short-term investment. And that's something that you highlighted in your paper. So the short-term investment, here's where I wasn't clear. I wasn't sure if you were saying that short-term investment was positive for the working class or detrimental to the working class, but my impression is that freeing up capital in order to stimulate short-term investment from the Minskian perspective could have been good if that investment was directed towards investing in labor, using technologies and production, but in most cases, it frees up money for stock buybacks, it frees up money to increase the degree of financialization in the market, so that every time we decrease the interest rate or engage in monetary policy in the United States, due to the massive capital market effect, what we're doing is essentially stimulating short-term investment, which is detrimental to the interest of the working class, because all it's doing is stimulating a greater degree of financialization. So given that context, when we think about what monetary policy should be for the future, then what are our suggestions? So monetary policy, every time we decrease the interest rate, we're having a negative effect on the working class. So how can, or do you have any suggestion, how can monetary policy be done, and can it be used to improve the situation of the working class? So right now we're facing a massive crisis. How can monetary policy be used to actually improve the condition of the working class? That's, can monetary policy be used? So that's my question.
Before I turn to Yvonne, I'm just going to jump in. I think many people here will agree that monetary policy is very limited in its ability to do exactly that, Joël, I would argue, and that we need to use fiscal policy, not monetary policy. I'm not a huge fan of monetary policy in that sense. Having written those interest rate rules policy. But anyways, the question was for Yvonne. Yvonne, please.
No, I agree with Joel. I mean, yeah, so that's why I try to highlight in my paper is that because we are now in this financial-led region of accumulation, all these when the central bank cuts the interest rate, that will affect the working class people in the sense that all the CEOs and all these people will try to get into short-term investments, trying to get more money for them and for their salaries, but not investing in bring some more people to new technologies or something like that. So that is pretty clear there. About if monetary policy can do something, I don't think so. Maybe what Keynes used to say, the interest rate should be zero, and then we have to bring the fiscal policies. So actually what I think is we have to use the Job Guarantee Program, but also I like the ideas by Larkin Currie, that was a Canadian economist who was professor in Columbia. And also he was one of the first economists for Franklin Delano Roosevelt. So what he did in his last years was talking about the leading sector. So we have to think about trying to plan our economy. So we can use the Minskian approach and the approach from Larkin Currie on a Job Guarantee Program, and also try to plan our economies, where you have to bring focus on those sectors that lead in other sectors. And that is the only way I think we can have some, effect on that. Also, we can think of monetary policy besides, interest rate, but also the macroprudential and other financial institutions. And again, with Minsky, thinking about the community banks that help these, communities, those projects that cannot get money from the commercial banks. And in that way, we can bring some power to workers and maybe try to help to get better share in the wage share. But that is the only thing I can think right now.
Thank you.
Louis-Philippe,
David Leadbeater, yes, please.
can you hear me?
Yes, I'm going to maximize your, go ahead.
Well, you don't have to maximize. First of all, I'd like to take up Joel's point. Anything that raises the issue of working class conditions is, in my opinion, a proper question for policy. So, Yvonne, every technocratic discussion is not purely technocratic. It has a class implication. And I would like you to bring out those more clearly in your paper, okay? So that's the first thing, and I think that Joel said that and did it well. Look, I mentioned at the beginning of the discussion, the debate that's starting to emerge, even in sort of wishy-washy circles, about the class aspect of quantitative easing. If this is considered part of monetary policy, then sure as hell, monetary policy has major class impacts in its effects on asset prices and the protection of assets. Now, I'll tell you something for the labor movement. This is sort of a bit of inside baseball, but I actually think that one of the reasons why the labor movement and some of the more established professional unions, for example, professors, are not more active on this issue is because asset prices are closely related to pension holdings. And so it's possible to say to better off parts of the working class, we have to inflate assets in order to protect your pensions. Now, there's a lot else going on, but there's a kernel of truth in that. And what I think a huge issue is of monetary policy, if those pensions I take as being a delayed form of wage payments, you know, how they can be separated, not integrated, but separated from stock market conditions. And so using your technical skills and understanding of the monetary policy and proposing to labor unions and to other working class organizations of de-stockification of the pension system is really crucial for changing the political and class balance about this issue of quantitative easing as being for the rich. Okay, so there's a concrete issue. How to separate the pension system, and it's trying to sweep in an interest broader than just the, minus, one small fraction of the ruling class into their support of stock market conditions that favor them at the expense of workers. Incidentally, in the period of the financial crisis in the mid-19th century, Marx argued to let the blighters go under, okay? And I would too, if it weren't for some of these issues like pensions, and then have them be reconsolidated and not refloated, but broken up into public banks and other institutions to shift forward political power more in the interests of communities and the working class. But you, I think, are onto something. It's just give it more of an edge in terms of the political implications and what it might mean for working people. Thank you, sorry.
Thank you, David. Ivan, do you want to respond or?
No, I
Yeah.
agree with that comment. I think it's pretty useful. Although, well, maybe saying that if you go to, the French Regulation School, they have how they define the different regimes of accumulation. You can see that it's in this financial led regime that we have the power of the hedge funds, and that's how we have this problem between the workers and because of the pensions, that pensions get a lot of money because of the stock market. And you can see that they have some proposals about how to solve that problem, but I didn't bring that to my paper.
Well, I would say that empirically, the issue of pensions figures even larger in the United States and Canada in the political economy than in several European countries. But that's a issue for more institutional analysis, and there's a lot of empirical work that's already being done. Okay.
Okay, thank you very much. Ivan, I was very happy to hear a reference to the French Regulation School. Okay, Well, I want to thank everyone. I think we're done. I think with this went very well in terms of presentations and dynamics. I apologize for not knowing how to allow you to share your slides. I'm going to work on that right now. I want to thank everyone, the 3 participants, for their time, and those who participate with questions and comments. Thank you very much. As I mentioned at the beginning, this is the first of 6 webinar based on the forthcoming book on the future of central banking that I'm co-editing with Silvio Capes and Guillaume Vallet. I want to remind you that also the next one will be on June 1st, and that will be on monetary policy and gender. And we will have Elissa Brownstein presenting, Guillaume Vallet presenting, and our own Canadian-born Brenda Spotton-Lozano presenting as well. I also want to remind you that next week, on the 25th, there's a ROPE webinar with Matthias Grasselli, Richard Werner, Christoph Lehmann, and possibly Brett Fulweiler. I haven't been able to reach him to confirm. And then Mario Sequereche as our commentator. That is part of a symposium that will be published in the Review of Political Economy, either as a stand-alone symposium or in a joint symposium with Mario's journal that we're currently working on. But next week's webinar for ROPE is on, have central banks learned anything from these crises? Originally, it was about the financial crisis, but I think the timing is perfect to incorporate discussion on central banks and COVID-19. It's going to be, I'm assuming very technical, so I better know how to allow people to share slides. Thank you very much, everybody, and I will see you all next week. Bye-bye. Nice to see you all.
Thank you. Bye-bye.
Bye-bye.
Bye.
Bye.
Thank you.
Thank
Au
you.
revoir.
Merci. Bye.
Bye-bye. I just have to learn how to